Hello and welcome to this session. This is Farhat, in which we would look at inventory fraud. Inventory is often an important number for many companies, especially retailers. Any company that sells goods, they buy those goods, they turn around and they sell them. Inventory is important. For manufacturers, think about a company that manufactures vehicles like Ford Motor Company or General Motors or Toyota. Those companies hold their own inventory, so inventory matters. It's a big deal for many companies. Often it's one of their largest assets on the balance sheet. Some companies might have more inventory than cash, more inventory than any other asset. So inventory is important. Why? Because it directly influences cost of goods sold. If you purchase inventory, so this is inventory that you own, inventory that's sitting on the shelves, then what happened to inventory once this inventory is sold? Let's assume you paid for this box. It doesn't matter what's in that box. You paid $50 for this box. Okay, now you sold this box for $125. Now this is the sale price, so you sold it for $125. Now this $50 goes from inventory to an account called cost of goods sold, and now your profit for this transaction is $75. So the reason inventory is important because it influences, and you're going to see shortly, why it affects cost of goods sold, and in turn the gross profit, the $75, would affect your profitability. So let's go back to that important formula that you need to understand between inventory and cost of goods sold. So let's assume a company, for the sake of simple illustration, started with beginning inventory worth of, for the sake of illustration, $100 worth of inventory. Then throughout the year they made purchases worth of $500. Beginning inventory plus purchases will give us goods available for sale, which is $600. What's going to happen at the end of the year? Goods available for sale, it's either sold or left in ending inventory. So what we do is we'll take the 600 and we count inventory. And let's assume an inventory, what we have left in inventory is $150 in ending inventory. So 600 minus 150, that's going to give us cost of goods sold for $450. So this is important. This relationship is important in a sense that beginning inventory plus purchases gives you goods available for sale. At the end of the year, at the end of the month, at the end of the accounting period, once you determine what your ending inventory is, you subtract ending inventory from the goods available for sale, and that's going to give you cost of goods sold. This is an important formula before we proceed any further, and you should have learned this in Accounting 101. But rest assured, you will see this formula in intermediate accounting, in cost accounting, in managerial accounting, and advanced accounting, on the CPA exam, on the CMA exam. So before we proceed, I want to make sure you understand this formula inside out. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, FarhatLectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
Now, Remember, we talked about ending inventory, and this is where it gets interesting, because remember that ending inventory number, when we count ending inventory and we said it's 150, what if we exaggerate ending inventory and bring it to 200? What would happen? Well, let's go back and see what would happen if we claim we have $200 more. If we claim we have $200 more in ending inventory and we have goods available for sale 600, now we gave our cost of goods sold a discount of $50. So by increasing ending inventory, notice by increasing ending inventory by 50, you reduce cost of goods sold by 50. So this is where it comes interesting. More inventory, if you claim more inventory, it's you can manipulate profit, and that's why ending inventory is important. It's a negative relationship. It's a seesaw. It's like a seesaw relationship. Simply put, if we're going to do a seesaw here, and if we have ending inventory on one hand and cost of goods sold on the other hand, if we claim to have more ending inventory, so if we bring the seesaw up, if we claim to have more ending inventory, what's going to happen to cost of goods sold? Cost of goods sold will go down. Also, if we happen to claim less ending inventory, so if we bring this seesaw down, cost of goods sold will go up. It's a negative relationship. So when cost of goods sold goes down, profit goes up. So simply put, what we want to do, if we want the profit to go up, we claim that we have more ending inventory, and this is gonna bring cost of goods sold down. Cost of goods sold down. On the flip side, if we understate ending inventory, the profit goes down. It's a zero-sum game. Now let's take a look at one more example with numbers. If beginning inventory is $500,000, purchases is 7.5. So goods available for sale is 8 million. Ending inventory is $1 million. Now we know cost of goods sold is $7 million. Now, if the company claims ending inventory to be 2 million, so we went from 1 million and we counted more inventory. We created fictitious inventory. Then what's going to happen? Our cost of goods sold will go down to 6 million, which will give us an additional $1 million in profit. So by lowering ending inventory, we boosted our profit. So that's a very important relationship. Very, very important. A famous example of inventory fraud is the Crazy Eddie example. Crazy Eddie was a consumer electronic chain in the New York, New Jersey area, basically the Northeast, around the New York area. This is before we had those national stores like Best Buy, Staples, and Office Depot, and all these national stores. So it was an electronic retailer. And what they did, they are known for overstating their inventory to make their financial statement look better. So what they did, they inflated. They claimed that they had more inventory because they were selling the company, selling it to investors. They wanted to show that they have more profit. So what did they do? They went up with inventory. Cost of goods sold went down. Now, when you have inventory like this, it's good to look at the numbers. When you're manipulating inventory, it's going to show on the numbers. So let me show you the financial statement for Crazy Eddie. This is 1985. So their sales is 136. This is most likely in millions. A minus cost of goods sold 103. Gross profit is 32. Gross profit percentage is 24%. Okay, that's fine. Their inventory is 26,000. Inventory turnover 5.2. Okay, great. The following year, 1986, sales went up. Inventory went up. Cost of sales went up, it's understandable. Gross profit is 67,000, and gross profit percentage is approximately the same as the prior year, a little bit better, but that's fine. Nothing unusual. It's a bit high than relative to the prior year, but nothing unusual. But notice what happened to inventory. Inventory went from 26 to 59, so their inventory doubled. Okay, and their inventory turnover is slowing down, went from 5.2 to 3.2. So they have more inventory that's sitting on their shelves that they are turning over, because inventory turnover is showing it. They have more inventory sitting on the shelves. Let's take a look at 1987. Again, sales went up. That's fine. Cost of goods sold obviously goes up with the company selling items. Their cost will go up as they sell more. Their gross profit is 80,000. Their gross profit percentage went down. Okay, went down. It's not good, but it went down. But notice what happened to inventory. Their inventory almost doubled again. So what's happening to their inventory? If they're selling, why are they having more inventory? Their inventory is increasing. And notice their inventory turnover is down to 2.5. Their inventory is slowing. So what happened to Crazy Eddie, to make the long story short, they were inflating their ending inventory to reduce their cost of goods sold. So that's basically what happened. Eventually they were caught. So analytical procedures here would help tremendously. So what's happening? There's a documentary about Crazy Eddie. If you go on YouTube and if you go on YouTube and you put Crazy Eddie, they're going to show you their crazy ads in the 80s. They're really funny, crazy ads, but they're funny. You can look at them. But also there's a documentary. Somebody made a documentary. So the auditor responsibility is to verify the existence of physical inventory. So what Crazy Eddie used to do, they used to tell the auditor, they used to put the boxes on high shelves so the auditor could not reach them and say, okay, there are like 10 TVs up there, 1, 2, they will count them, and those boxes were empty. And usually the auditor might test selected samples, and company Crazy Eddie was taking advantage of that. And what they did, the Crazy Eddie, what they're known for is they moved inventory around to make it seem that they have more than what they really did. So they would move inventory from one warehouse to another. So they would move it from one warehouse to the other, fooling the auditor into thinking they have more inventory than they do. And this is me, and this is in 2013, and this is Crazy Eddie. He came one day for the student award school I was teaching at, and he talked about the documentary. Again, you can Google the documentary. I'm not sure if it's on Netflix, but it's on YouTube. At least it was on YouTube, so you could look at it. So I met him in person. So this is basically a classic case for inventory manipulation. So to wrap it up, what are some warning signs and red flags? You gotta look at inventory, at analytical procedures related to inventory related accounts, such as gross profit percentage. Gross profit percentage is important, but they were able to keep it the same, but they could not control their inventory turnover. So their inventory turnover was going down, and that did not make any sense. A fictitious inventory understate cost of goods sold and overstate gross profit. So their gross profit was way, way lower. Any slowdown in inventory turnover is a red sign. It means your items are not selling. If your items are not selling, how can you be making the same profit? Because if your items are not selling, it means you're not selling, and if you're selling, your profit is going down, because if it's not selling, you have to lower your prices. Therefore, you make less profit. So you would look at decreasing inventory turnover, which was a classic case in Crazy Eddie, and increasing inventory level. You clearly saw that. An unusual gross profit percentage. Gross profit is fluctuating a lot. For retailers, 1 or 2% is a huge gross profit percentage. Companies like Walmart, Costco, anything that they sell items. Why? Because they're always under pressure. Retailers are under pressure because they all sell the same items, so they cannot make a lot of profit. When you sell the same item, your profit margin is very small. It's not only small, it's always squeezed. Squeezed means you cannot increase it too much, because if you increase it, if you try to make more profit, customers will go somewhere else. Because if you're selling the same deodorant or the same toothbrush, you can buy it from Walmart, you can buy it from Target, you can buy it from Amazon. The same item, the same toothbrush. So you cannot sell it for more and make more profit. If you want to sell more of toothbrushes, lower the price, your profit goes down. Let's take a look at this multiple choice question from farhatlectures.com. Which of the following is not performed by the auditor to address the heightened risk of fraud? This one is not addressed. Let's start with D. Using the work of a specialist to evaluate the accuracy and reasonableness of management estimates. Would you do that if fraud is suspected? Yes, if fraud is suspected, I'll bring a specialist to look at the estimates, at the valuation, at the accuracy of management. So I will do that. So D is not an answer, because I will do that, because the question is not performed. Performing analytical procedures at the disaggregated level through data visualization tool. Sure, why not? You will do that. You would look at the data at a much smaller level to figure out what's happening at the low level. Maybe you'd look at it at the aggregate level, so on and so forth, but you will use analytical procedures. So this is performed. C is out. Using a generalized audit software to source for fictitious revenue transaction. Will you do that? Yes, if you're suspecting fraud, you would look for fictitious revenues. For example, if somebody have a PO box or an address for for someone, the same address that work for the company. So yes, you will do that. So by a process of elimination, A is the answer. And A, it says decrease extent of substantive testing. Not at all. When you suspect fraud, you do more. You increase, not decrease. You will increase the extent of substantive testing. In other words, you will do more field work. You would look at more samples. If there's any one particular area, you might want to, if it's a small area, you want to audit everything 100% if you suspect fraud to see what's happening. You will ask more questions. You would look at external confirmation related to that area. But definitely you will not decrease if fraud is suspected. What should you do now? You want to go to Farhat Lectures, look at additional resources, multiple choice, additional lectures that's going to help you, whether you are an accounting student or a CPA exam candidate. Invest in yourself, the best investment you can make. Good luck, study hard, and of course, avoid fraud.